Well, I'm here with Jens Welter, who is the Managing Director and the Global Head of Consumer and Retail for Credit Suisse. Jens, thanks very much indeed for joining us. We at WPP, 170,000 people around the globe every day spending their time building brands. From a financial perspective, from an investment banker's perspective, is there a great value in brands? And when you look at a deal, how important is the brand from a strategic perspective?
David, I think the brand probably ranks as the number one, maybe the number two most important thing that strategic investors will be looking at in a transaction. At the end of the day, the two things that will weigh the most for a CEO that is looking at an acquisition is the attractiveness of the brand and the attractiveness of the category that he's buying into. The category itself has to be attractive, it has to have the necessary long-term growth rate, and it needs to show the ability to grow within that category through innovation, through marketing.
Presumably, in a company where you're acquiring a brand that goes into a portfolio of other businesses they might have, the strategic fit that brand has with the other brands within that portfolio.
The work that is being done in terms of the large consumer products company mining country by country to understand which are the right attributes of a brand is ultimately the blueprint of what a corporate development department is looking at to be able to then acquire and say, is there any way of acquiring these brands to be able to achieve that sort of portfolio of brands that a company is looking for.
So I suppose here's where the sort of rubber meets the road in a sense. So when you're pricing a deal, when you're looking about whether you're buying or whether you're selling, are stronger brands priced at a heavier premium than weaker brands?
Yes, they are. There's clearly a premium, a significant premium for strong brands. We wouldn't actually value the brand discretely and then we value the fixed assets of the business, but we'd look at an overall cash flow of the business. And it's in terms of those cash flows that you would very much see the cash flow return on investment being significantly better for a business that has strong brands. An acquirer will want to ensure that the necessary investment in advertisement, in promotion, in marketing has been there to sustain that brand equity.
And that is something that you actively look at, which is how much has been invested in the past, and that's a way of seeing whether actually that brand has been sufficiently nurtured to be able to sustain those cash flows going forward.
Correctly. There can be times where you could probably underinvest, as we would call it, in a brand, but that does catch up over time. I think the second element is really the reason that strong brands deserve a premium valuation. Think of a brand like Coca-Cola, is the ability to be able to charge premium prices with a underlying invested capital that is significantly less than if a company wouldn't have those types of brands.
And the flip side of that, presumably in certain deals, there's huge value that can be unlocked in regenerating a dormant brand.
There are certain categories where we will find buyers that are particularly good at finding brands that are somewhat dusty, that have a certain value. Either historically they've represented a value and have been unloved, that once they're divested and they're being provided with some love, some investment, some innovation, actually can be reinvigorated. So
looking slightly to the future, do you think that the brand is going to become a more important consideration or a less important consideration in M&A going forward?
I do think that there is, in many of the large FMCG categories, there's been a lot of consolidation. So the scarcity value with regards to brands coming up for sale means that there is a lot more interest in iconic brands that are available, just because there's a lot less that comes to market these days. So I do think that where brands have those specifications, we are seeing a expansion of multiples that are being paid for those brands. And that is also coupled with a lot of the FMCG companies having become much better at integrating brands like that and generating the synergies, i.e. making the returns work at even higher multiples than what we've seen before.
Now, it's been a pretty tumultuous time for corporations' M&A activity the last 5 years. Martin Sorrell talks about we're in this sort of corrugated bottom in terms of the economic cycle at the moment. Again, looking forward, do you see an increase in M&A activity over the next few years?
We've noticed a steady increase over the last couple of quarters. There's a lot of signs with regards to the consumer environment stabilizing in a number of northern European countries. The consumer environment has been strong for the last 12 months. We see somewhat weakening in emerging markets. Having said that, the financing markets are so strong that it is very difficult to actually look at an acquisition and not make the numbers work.
And you can't help but look east at the moment. A lot of Chinese companies now have very strong balance sheets. We see interest from Chinese companies of interesting brands around the world. Do you see a big sea change of Chinese companies and companies from emerging markets making acquisitions of quality brands around the world?
We do see a lot of interest by Chinese organizations that are looking at brands that would otherwise take decades to build up, brands that have certain heritage. At the end of the day, those brands have to work in China. It is rare that we see situations where a Chinese buyer would buy a brand that only works in the domestic market but doesn't work in the home market for them. And that by definition means that there's certain categories where there's more interest than other categories.
Great. Well, Jens, thank you very much indeed for joining us and being with us. It's been very enlightening. Thank you.
It's a pleasure. Thank you very much.